Hello traders, and welcome back to my channel again. I'm Paper International. Before the end of this video, I'm going to show you with a practical examples of a previous trade of what we're about to discuss in this video. So make sure you watch this video to the end. Only takes a trade if it passes these 5 conditions. Only take a trade if it passes these 5 conditions. Let's say, for example, the market is a firm or an entity that provides buying and selling offer to you for a certain reward. And to take this offer, you must risk your hard-earned money for the reward. If your prediction is correct, you get your reward. But if it is wrong, you lose whatever you put in that trade. Now, you as a trader, you need to have your own conditions available for the market to adhere to before you take that offer or risk your hard-earned money. Or would you rather just jump into the market anytime you wish to without considering any factors? If you don't want to be losing more than you are making, then you need the market to present these 5 conditions for you before you ever take a trade. These conditions apply to all markets, including Forex, crypto, stock, synthetic, and future tradings. 1. Trend or direction. If you're a trend following trader, then a trend needs to be present before you even consider to trade that particular pace. Or if you're a range trader, then you still need to know the direction of the trade before you consider trading that pace. Do not take trades on any particular pace that does not have trend or even direction. That is to say, a market that is just consolidating or a ranging market. You should avoid the ranging market until you start trending and you know the direction of the trend before you consider trading that pace. 2. The risk or stop loss. Never take a trade where the risk is greater compared to the reward. Stop loss is mostly placed behind the latest swing low for a buy trade and placed behind the latest swing high for a sell trade. This is because the latest swing low is an area of support which will help to support or hold back the market whenever the market tries to reverse against the trend, while the latest swing high is an area of resistance that will help to hold back the price whenever the price tries to reverse against the trend. So placing your stop loss behind the support or resistance area will help to protect your trade or stop loss order from being taken out. For example, I have seen lots of trade where a trader will be taken out of the trade or stop loss order got hit. Then just immediately after they are taken out, the market start going in their direction, but without them. It has happened to me, it has happened to a lot of traders, and so many other traders are still doing that mistake. So what about in a situation where the market has gone too far from the latest support or resistance area? That is the latest swing high and swing low. That will make the stop loss to be too large, right? If you must take that trade. That is where we consider the risk. If the risk is larger or greater compared to the reward, you should not take that trade. Some traders do not take a one-to-one risk trade. That is to say, the risk and the reward are equal. So in a case where the market has gone too far from your entries, the best thing to do is to wait for a pullback. The market is always known for a retest. It will always come back to retest a zone that it took off from before continue going in the trend direction. So you wait for a pullback or a retest. Also, you need to think twice before taking a trade where the risk and the reward are the same. 3. The reward. The reward is the profit potentials. The profit target is determined based on something measurable and not something randomly chosen. There are different ways of measuring profit targets, of which include using support and resistance key level. The theory of this is that price usually struggle to break above certain resistance or support level, most especially on the higher time frame support and resistance level. So your profit target is determined from your entries to the next support if you are selling and to the next resistance key levels if you are buying. Then you calculate and compare the risk to the reward and see which is greater. If the risk is greater compared to the reward, you stay out of the trade. the reward should be at least 2 times greater to the risk. The second way of measuring profit target is by using trailing stop loss. It's by the help of indicators like the moving average and other indicators. You continue to tightening or readjusting your stop loss as long as the market continue going in your direction and is trading above the moving average if you are on a buy trade, until the price break below the moving average. Although we'll discuss that in details in another video, there are some other indicators too. Trade triggers. Trade triggers. This is one of the most interesting part of this video, the trade triggers. Let's say we now have all the conditions mentioned earlier present in the markets. We have known the trend direction, the risk is okay, the reward is good. Now is the time to enter the trade. Do we just jump into the market like that? Remember, we have not forgotten that it is still our hard-earned money that you are about to risk. We need a trade triggers. We need the trade to show us a signal or a precise event that tells us that now is the time to trade. This is because some moments do provide great entries than others. So the best time for entries is when the market creates a new lower high, if the market is on a downtrend, or a new higher low for an uptrend. So what are the trade triggers? They are the candlestick patterns like the engulfing patterns, the pin bar rejection candle, the harami, the morning and evening star, and other candlestick patterns that suggest a powerful signal for a trade takeoff. 5 other conditions like breakout and retest. If a market is ever in a pattern, you must wait for it to break out first, no matter what kind of pattern it is, whether flag pattern, wedge pattern, head and shoulder pattern, a channel, a double top or bottom, a triple top or bottom. You must wait for the second button to completely form before you enter the trade. After the breakout, the market will move a bit and come back to retest the zone before moving to the destination. So pullback or retest is very common these days, to the extent that many traders don't take a trade if they don't see a retest after a breakout. So many traders have also added a retest to the list of their conditions. If there is no retest after breakout, then they are not taking that trade. Although not all traders do wait for a retest, and not all breakout must retest, but it is good to have extra filters to help you confirm what trade you are about to take. So without wasting much time, let's quickly take a look at a practical example. So here on the 4-hour time frame on USDJPY, which is our higher time frame, we are mostly interested in the trend direction, and we can see very clearly that we are in an uptrend. The market is bullish. If we zoom in closer on the same 4-hour time frame, we can see that the market has been creating higher low and higher high, and it is trading above our 50 period moving average, which means we should only look for trading opportunity into the trend direction. Let's zoom into the 1-hour time frame for more details. And here on the 1-hour time frame, we can see that the market has printed a double bottom, but it is in a resistance area. This previous area of resistance is acting as resistance here again after the market has created a higher low. It is failing to create a new higher high, or let's say it is struggling to create a new higher high. The market has been making attempts, but it's been rejected back into the resistance area. It has made the first attempt and the second attempt, but it's been rejected back into the zone. So we cannot enter the market now, as the market is still in the resistance zone. We need the market to break out first before we start looking for trading opportunity. And not just a breakout. We need a breakout and a retest as well. So if we zoom into the 50 minutes time frame, this is how the consolidation look like on the lower time frame, which is the 50 minutes time frame. But we don't need to look into the 50 minutes time frame yet until the market breakout on the 1 hour time frame first. Then we can now zoom into our entry time frame for more factors in order to avoid directional confusions. And finally, we have a breakout. But the breakout is too large that it will affect our reward if we enter the trade immediately. Our stop loss is going to be too large and our profit target is going to be too small, considering the fact that we are targeting the next resistance key level. We don't know if the price is going to break above it, but we just have to be on our guard. Even if we believe that it is going to break above it, it is not a guarantee. The market may end up creating a double top or fail to break above it. So our first profit target is at the previous resistance zone. Then other targets can be above the resistance zone based on what we believe, so as to help us should in case if the market fail to go higher. If the market fail to go higher than the resistance zone, we can use trailing stop loss if the market break above the previous resistance zone, as discussed earlier in this video. So now that the market has breakout and the breakout candle is too large that it will affect our reward, we need to wait for a pullback or retest, as discussed earlier as well. This is now when we zoom into our entry time frame to wait for the pullback or retest. So we are now waiting on the entry time frame, which is the 15 minutes time frame. We are waiting for the pullback now to happen. And if there is no pullback, then we have no reason to take this trade. We have to let it go. If you remember the conditions we discussed earlier, breakout and retest is also part of it. And in this case, it is only when the market retest that our stop loss and take profit are going to fit into the conditions that we have discussed so far. If we enter the market from here, we won't make enough profit. And when the market is going to retest, we are going to be at a drawdown until it comes back to the point where we enter the market from. That is when our profit will start counting. And if you remember very well, we discussed earlier that the best time to enter a trade is when the market creates a new higher low for an uptrend and a new lower high for a downtrend. So in this case now, we are in an uptrend. We are buying. So the pullback or the retest that we have been waiting for will now serve as the new higher low for the uptrend. And as you can see, we have the retest happening already. So we wait for it to complete. And then we now wait for the final condition, which is the trade triggers as discussed earlier. The trade triggers are the candlestick patterns that suggest a trade takeoff. As you can see here, this previous area of resistance is now acting as support, preventing the market from going further. So all we need to do now is to wait for the market to provide us the trade triggers so we can finally purchase or enter the trade. Finally, the market has now provided us with our last conditions, the trade triggers. In this case, we have the bullish engulfing candles. So we can now finally enter the trade. But before we go further, let's quickly recall on the conditions provided so far. We have known the direction of the trend. We are in a trending market. We are bullish in trend. The market was in a previous area of resistance and we wait for a breakout. After the breakout, we also wait for a retest. We weigh the risk, which was okay. We compare the reward to the risk, which was good. The reward outweighed the risk. It was at least 2 times the risk. And now we have the entry triggers to trade into the direction of the trend. At first, all of these conditions might look like something you need to put into practice every day. But once you get used to the steps, it takes only a few seconds to run through all of these conditions. So after we enter the trade, the market keeps going on in our directions until the close of the sessions, which will close the market in profit. There is no need to let the market run over the night. Each session has different ways of affecting the market. And then, as you can see, The next day, the trade went in our direction, but it almost took us out before continuation. So these are the 5 steps you need to look out for in the market before considering taking a trade. For more videos and explanation, consider subscribing to this channel. And if you like this video or find it helpful in any way, give it a thumbs up. And also, we have a free signal channel on Telegram where we drop free signals on currency pairs and gold as well. We trade forex and synthetics on the roof base. So feel free to check out the channel so you can earn while you learn like others. Every trade we took, we provide a signals as well in the Telegram channel. So go ahead and check it out for yourself. The link is in the description of this video.